Avoid this small mistake when you start your business, and it could save you thousands or even millions of dollars when you sell. So I'm a lawyer with 25 years experience. I started out doing securities law and mergers and acquisitions, and I worked on some of the largest mergers in the world, including the AOL Time Warner merger. And this is my YouTube channel. So today we're going to talk about 83B elections, and they must be done at the beginning. If you want to make an 83B election, you have to do it within 30 days of your purchase of the stock or being issued the stock. You can't do it retroactively. You can't backdate it. It has to be within 30 days of the stock grant or purchase, and you have to file with the IRS. It used to be that you filed something on paper, but now you can do it electronically, but it has to be within 30 days. Otherwise, you lose the right to claim this. And there's other things you can do after the fact to try to correct this, but the easiest and best way is to do it at the beginning, file an 83B within 30 days of being granted restricted stock or buying it. So when you set up a new business, the company's probably not worth a lot. And if they issue you a bunch of shares here and you paid tax on it, you'd be out money in the beginning. And given the choice between paying money now or paying money later, most people would pay later. But there's a problem because if the company, especially if it's a software company or something like that, ends up being worth a lot of money at the end, then paying tax on it here is a lot less than paying taxes on it here. So let's assume they gave you 1 million shares and they vest over 10 years. And currently, that 1 million shares is worth 100,000. If you paid the tax here, it'd be regular income. And if you're in a high tax bracket, that sounds like a lot. But if you don't make the election and you're issued the stock and it vests after a year and every year after that, let's say it vests, it's 1 million shares and you get, it vests 10,000. Let's say it's 1 million shares and it invests over 10 years, 100,000 shares a year. Then on the first 100,000, you'd pay tax here. The second 100,000, you'd pay tax here. The second 100,000 here. So then at the grant, you wouldn't pay, but on the first year when it vests, you'd pay here. On the second year, when another 100,000 vests, you'd pay here. The third year, another 100,000 vests here. The fourth year, another 100,000, you pay here. And as they keep vesting and the company goes up and up in value, you're paying more and more tax when you could have avoided it by just taking a small hit up front. Is there any drawbacks to this? Sure. There's no guarantee that the company will succeed. And if you made an 83B election and you paid the tax here, and then the company ends up being worth nothing, you don't get a refund on that tax. So here's how it would work. You get issued the shares, and they're restricted shares, but they vest over a certain period of time. And rather than pay tax as they vest, you want to pay it all up front. So you would use this form, IRS 5620. You give it to the company. They mail it to the IRS or file it electronically. And then when you file your taxes, you're going to include the 83B election. And as I said, you used to have to do that on paper, but now you can do it electronically with the IRS. And this will come in really handy if the stock that you're issued is part of a business that later qualifies as a qualified small business under the IRS rules. So this is an extreme example. She gets 1 million shares. They vest 25% each year. In the first year, because it's a startup, they're only worth $100. She pays tax on the $100 now, and by the time they reach $1 in value, the 250,000 shares she got in year one, she doesn't owe any taxes on it because she already paid it through the 83B election on the value when it was issued, not when they vest after a certain period of time. So here's another example where they receive an initial grant of shares. And if you don't do anything, you have 30 days to file the 83B election. You wouldn't pay tax on the initial issuance. However, at the end of year one, when the shares are now worth $10 a share instead of a penny a share, they're paying $16.50 in tax. At the end of year two, it's now worth $100 a share. They're paying additional tax here. And when they liquidate at $150 a share, they pay here. However, if you do file the 83B election, you paid the tax here, which is small. At the end of year one, where it's worth $10 a share, you're not paying any additional tax. At the end of year two, where it's paying $100 a share, you don't owe any additional tax. And when you liquidate in year 2.5, they're worth $150 a share, and the tax here is $30,000. So the tax on a very profitable business would be lower here than here if you elected your 83B election. However, there is a way to make this zero. So you can combine the 83B with something else, and that's covered here under IRS Publication 550. Under Section 1202 of the IRS Code, for stock that is a qualifying small business stock, it used to be that you avoided half of the gain on that, and then that was raised to 75%, and now it's 100% up to $10 million. Now, the tax law is always changing, and this year is no different. So recently, Congress passed the so-called One Big Beautiful Bill, which is a ridiculous name, but it affects this section, so we're going to talk about it. So for certain companies that qualified as qualified small businesses, an individual who was issued stock and then sells the stock, would be entitled to exclude $10 million of that from taxable income. And that has been raised to $15 million after July 4th, 2025. And the holding period has also changed. So it used to be that you would need 5 years of holding to qualify for this exclusion of $10 million from your basis in the stock. But now that's been reduced to 3 years, and the exclusion has been raised from 10 million to 15 million. So if you can combine this 83B election with paying tax here at the beginning when it's very low value with this IRS 1202 exemption, which now lets you have 15 million of the gain excluded from your taxes, that's a very powerful combination. So in the beginning of the video, I specifically mentioned software companies because they're the ones who most often take advantage of this Section 1202 exemption or deduction. And that's because not every business can qualify under this Section 1202 when you sell your business. So one thing to keep in mind besides the holding period is that you have to have bought the stock directly from the company. You can't have bought it from another shareholder. There is the holding period that I mentioned, and the corporation has to be an eligible corporation. So it has to be a C Corp. S Corps are not eligible, and neither are LLCs unless they elected to be taxed as C Corps, which most people who elect LLCs choose pass-through taxation, so that wouldn't apply. And there are also only certain professions that or business lines that apply to this Section 1202. So it doesn't apply to real estate, which includes hotels, motels. It doesn't apply to hospitality, which includes restaurants, no oil or gas, no farming, no financial, so no hedge funds, no private equity, anything like that. And unfortunately for people like me, it doesn't include law. So if you sell your law firm, it doesn't include engineering, architectural, accounting, consulting, brokerage, etc. So when you cut all that out, what does that leave? Mostly software companies. So once again, the 83B is a powerful tool, but you have to elect for it in the beginning within 30 days of being issued the shares, not when they vest, when you're actually issued the shares prior to vesting. And you can combine it with Section 1202 and get that force multiplier, but only in certain industries, not any of the ones that you're seeing on the screen. And if you don't make the 83B election in the beginning, all is not lost. There are ways to work around it, but it involves a lot of steps. It's very specialized, and you need a very good lawyer. What you definitely should not do is try to backdate it or anything like that. That will get you in a lot of trouble with the IRS. So that's it for today. Once again, my name is Pete. I'm a lawyer with 25 years experience in mergers and acquisitions, financial markets, derivatives. And if you want to work with me either on a consulting basis or hire me as an attorney, you can use the contact information on this YouTube channel, which will take you to my LinkedIn or my webpage, and reach out to me there. So if you have any questions or comments, leave them below. And if you have any future videos you'd like to see or questions about what I've just written, leave them below. And because I'm a lawyer, I will give you the disclaimer. This is not legal advice. This is for education and informational purposes only. And nothing that I've said here creates an attorney-client relationship. Anything you see here, you should verify yourself or discuss with your own counsel, because things like tax law are constantly changing and may become outdated, and I do not have a duty to update this video or to advise you of any changes. So have a great day, everyone.